Good day, everyone. The Society of Actuaries is pleased to present this webcast, The Evolution of Predictive Models in Life Insurance Underwriting. We are very pleased to welcome all of you to this program. My name is Eric, and I will be your host for today's webcast. Please note that today's call is being recorded, and all participant lines will be muted during the broadcast. If you are listening to the program over the phone and you need assistance at any time today, please press *0 and an operator will assist you. Today's presentation will last up to 60 minutes and include a specific question and answer period. However, you can enter a question for us at any time during today's presentation. You may submit a question by typing it into the box in the lower left corner of the window, then be sure to click on the send button located next to the box. If you are listening to the program over the audio only and do not have access to the chat box, you may submit your questions to soa@compartners.com. These instructions will be repeated later in the program. In addition, I would like to draw everyone's attention to the links box located to the left of the slide. To view or print the presentation slides, click once on the handout link and a separate web browser window will open to display the information and allow you to print it. We would like to remind you that the SOA adheres to a strict antitrust policy. For more information on the SOA's antitrust policy, please visit the SOA website. One final disclaimer, presentations are intended for educational purposes only and do not replace independent professional judgment. Please refer to the SOA's presentation disclaimer. Now it is my pleasure to introduce David Moore, who will introduce today's session. Please go ahead, David.
Thank you, Eric, and hello, everyone. My name is David Moore, and with me today is Jason Von Bergen. We'll get into quick introductions in a second, but first, just a background on our presentation or session that we're doing today. Now, Jason and I presented this about 2 months ago at the Society of Actuaries Predictive Analytics Symposium, and we're asked to do this as a webcast. So we have experience presenting this material, but I think the session will be a little different today because we don't have the benefit of a live audience in front of us asking questions. So we do want to get questions. We do want this to be interactive. So please, if you have questions as we go through the material, feel free to type them in. And when one of us is speaking, the other one will be scanning those and jump in as necessary. So in terms of introductions, again, David Moore, I'm with Nationwide Financial. I'm an advanced analytics leader here. What that means is I am in charge of the delivery and adoption of predictive models, advanced analytics within our life and annuity company. I am an actuary, but also have been working with predictive models and with data scientists for a number of years now. So depending on the day, sometimes I'm an actuary, sometimes I'm a data scientist, I guess you could say. I have our first poll question, and that looks like people are starting to answer that. Jason, I'll throw it over to you for an introduction now as well.
Thanks, David, and appreciate everyone joining us today as well. This is Jason Von Bergen. I work at Northwestern Mutual, and my role here is I work in our risk selection strategy department, where we set the rules for underwriting across all of our products, life, disability, and long-term care. I lead our division that focuses on research and analytics to support underwriting for those different product lines. And so my team is responsible for traditional research that supports the development of our proprietary underwriting standards, both medical, non-medical, and financial, as well as the development of new tools for underwriting, including predictive models for automated underwriting programs and new data source research and development efforts. And so my team has been heavily involved with our in-house data scientists as we've developed our own accelerated underwriting capabilities and evaluated new and different data sources. And so my role is to incorporate that into our overall transformation initiatives around the purchase experience for clients, ultimately leading to a better client experience when it comes to underwriting and maintaining our commitment to fundamentals and policy owner value. And so really great to have everyone on the webinar today. And as David said, I do encourage folks to submit questions as we go. I think it makes this that much better.
Great. Thanks, Jason. I see we've got a good number of people answering our polling questions. We wanted to get kind of an idea of where people were coming from. As expected, mostly actuaries, mostly, I guess, a little under half, or sorry, over half at insurance companies, but a number of other places of work represented as well. So now we'll move into our session here. And the goal of this session is not really to just say, what we are or give a history lesson. It's really about understanding the history and how we got to where we are today and how we're using data science, predictive models to really enhance the way we do business in order to speed the design, get better at risk management, get better at serving the customer. So that's kind of the context of what we're looking at today and as we go through this. Given that we're actuaries, most of you on the call are actuaries, actuaries have been involved in predictive modeling for a long, long time. This is not something that's brand new. A lot of actuarial functions are around prediction and understanding statistical distributions and understanding risk. We go back into the 1700s to see when was the first experience study ran, which is really what we're doing. We're looking at the data we have, what it tells us about the past, and what pieces of that data can help us understand what is the likelihood of certain events, mortality, morbidity, otherwise going forward. Fast forward a couple hundred years, and it's also important to understand that as a life industry that we're really are following our brethren in the P&C side in terms of using alternative data sources, and predictive modeling tools to segment and predict risk. P&C insurers were well ahead of us in realizing there's some other data here that companies aren't traditionally using or haven't for segmenting risk that can actually tell us a lot about the distribution. And certain P&C companies were able to incorporate things like credit scores, like consumer data, and add that to their demographic data to be able to out-segment some of the other companies. And one of the reasons why you could say they beat us was that some of it being the risk profile in terms of looking at products that had a 6-month or 12-month time horizon. You could turn that data around, understand it. If you were wrong, you could correct yourself, so there wasn't as much at risk. On the life side, was a little slower in getting involved and looking at how these things worked. And one of the reasons, I think, was the duration of the products. And if you're looking at making a prediction on a 30-year term product or a whole life product, well, you want to be a lot more comfortable with the prediction you're making, and because there's a bigger downside of being wrong. So if we look at where we are today and some of the recent things that have been going on, in a real push from the Society of Actuaries around developing predictive analytics as a capability for actuaries and really making data science part of the SOA curriculum and understanding where that fits in. Again, the CAS beat us to having a predictive modeling seminar. They were doing that back in the mid-2000s. But the SOA in LIMRF, from a life insurance perspective, has really been moving very quickly the last few years. We now have the Advanced Business Analytics Seminar, which is now in its 6th or 7th year. LIMRA started with a big data conference and looking how do we apply these data science tools to life insurance across the spectrum within life and annuity, but there's been really a focus on underwriting as that being a high-value use case. The Society of Actuaries just had its 3rd Predictive Analytics Symposium, and now has fully incorporated predictive analytics and data science into the syllabus, so that we're, I think, coming up on our 3rd offering of the predictive analytics exam for the SOA. The Academy has data science and analytics committee, again, looking at how this impacts. It's been a big factor in looking at mortality assumptions and the impacts on PBR as you look at just what accelerated underwriting programs do. What are the trade-offs on items, data you're giving up and different data you're acquiring, which we'll get into during the session. And the last item on here I think is also very important to note, because as the industry moves, the regulators need to follow as well. And we have some specific thoughts on the New York insurance circular letter that was issued at the start of this year and how that impacts what we're doing as an industry and how we build models within life. So kind of that's how we got where we are today. It's certainly important to mention the data that goes into the predictive models, and I think there's still some maybe misunderstanding or uncertainty about what goes into data and how we got to where we are today. If we go back probably about 10 years when life companies started to look at pilot projects and in proof of concepts around, can we do this in life insurance the same way that they are in P&C? Some of those initial models were using consumer marketing data. So this is data that comes from credit rating agencies like an Experian, but is not specifically credit data. It's data that is typically used to understand consumer profiles and preferences. It's what the reason we get so many catalogs in the mail. People are buying data and understand, well, what other things do we buy? Are we buying running shoes? Are we outdoorsy? Are we into crafts, photography, etc.? And so that they can maximize their marketing budget. So initially, there were some life companies that did POCs into understanding, well, if I understand someone's behavior, are they going to be healthier because they're buying running shoes, etc.? Can that move the needle? When you're looking at a predictive model, you're trying to get a better response from really random if you didn't have that data before. So a lot of that data showed, yeah, there was predictive power. You could get some segmentation. However, the segmentation was so weak compared to what you already do as an underwriting function in terms of looking at medical and financial data that there really wasn't a lot of value in going that direction. So the next step, kind of the iteration 2 of the proof of concepts, was looking at the application data. What is the applicant, the potential insured, telling you about themselves, and how do you use that data to underwrite faster and more accurately? So this required maybe reconfiguring the way companies collected the data, digitizing, or at least enabling through a tele-app a better collection of that underwriting data up front, being able to use technology to connect with your third-party data sources, whether that's motor vehicle record, prescription drug history, at the time of application. So you have a much more complete view of the applicant. There's still that gap in the data from not having labs and not having doctor records. But that's really around what we're trying to address, the trade-off between speed and getting the absolute complete picture. So that was another step. Where we are now, we're looking at that traditional application data, but also looking at what other third-party data can provide you segmentation. I'd say the first breakthrough that really got us to where you could potentially get close on mortality and the view of the applicant was the credit-based mortality models. And there's two notable ones, LexisNexis Risk Classifier and TransUnion Truist Life, that have been built on data that's from people who are shopping for insurance, looking at millions of lives and looking at not just credit attributes but other publicly available data and building a mortality model on that. And with the amount of data, and again, data that is orthogonal to what an underwriter is looking at today was able to actually produce significant lift, when tested against actual life insurance underwriting. So you could take a group of people that all got preferred underwriting classes and see, plus or minus 20% on the actual to expected mortality based on those model scores. So that this is something that, again, not traditionally used, was injecting new information in the underwriting process, but showed significant improvement on the ability to segment risk than our traditional underwriting. And then the next breakthrough that I think we're on the cusp of is really how we use medical data and how we get that immediately and reliably at the time of application. Whether this is digital health data, electronic health records, prescription drug data. We've been using prescription drug data for a while now, but there's a lot of work going on by the health industry, and now we're starting to see companies, looking and focusing on how does a life insurance company benefit from this. We've done some pilots here to understand this a little better. We're not there yet, but I feel this area is really quickly advancing and can give us another lens to be able to use models to underwrite very quickly. With that, I'm going to pass it over to Jason, who's going to walk through the results of a recent LIMRA study and a little more detail on some of the data sources that we're using. So, Jason, I'll pass it over to you.
Thanks, David. And maybe I'll just take a second here and highlight a couple additional points to what David was discussing, because I think the context around this really is important to understand not only where we've come, but how quickly we've advanced. And so as you think about, there's really a confluence of factors over the last several years that has led to the ramp-up that David showed just a couple of slides previously. So if you think about one, just the availability of the data itself, and so I'll talk more about that here in just a minute, and David already kind of gave a preview of that. And as data has become more available, and whether that's digitizing data that has always been utilized in underwriting, or whether that's the bringing online of new data sources that are available to us, both of those have contributed to the advancement of building models based off of that data. Secondly, you've had just the advancement in the modeling techniques themselves, and advancement of data science as a profession, and how actuaries have embraced that. And again, David mentioned that, which is kind of really telling of how the profession has really taken this up and pushed it forward. I mean, I think everybody would recognize, if you went to an SOA annual meeting over the last 5 years, the idea of accelerated underwriting or predictive modeling has been heavily featured in many of our society meetings. So really recognizing the capabilities and ability of us to make changes. And another factor I would really point to is the focus on customer experience, and how as companies and life insurance companies in general have focused more on the customer experience in recent years, that has really brought a highlight to how can we use this data, use these techniques to improve that customer experience. And underwriting has been a place that certainly has had its challenges historically from a customer experience standpoint. There are plenty of people who didn't like the invasive nature of underwriting, but we needed the information in order to make accurate risk assessments. So with those confluence of factors, it really has led to the development of the capabilities that we're seeing now, the development of accelerated underwriting programs, automated programs, and the usage of predictive models therein. So as we talked about the data sources here, this is a little bit of a dated study at this point. This was done by LIMRA in 2017, so knowing that some of these things have certainly advanced since then, I'm going to take a minute and just kind of run through a couple of these for folks that aren't familiar with them. But a point at the outset here that I want to make is all data that we utilize in underwriting, number one, we have to get appropriate applicant authorizations to go after. And so, and I think that's actually a key point for us as companies to look at going forward is how we obtain authorization from clients, and what type of transparency and visibility do we have in that authorization process, especially in this day and age of data privacy concerns. I think that's going to be even more important that we have those clear authorizations for clients. Secondly is when it comes to the data sources that we use to actually make underwriting decisions, they need to be FCRA compliant, so compliant with the Fair Credit Reporting Act. And mainly one of the things that comes with it is the ability to challenge and understand the data that went into the decision. So whether it's any one of these data sources or others, it's going to be how that information is utilized, and we'll talk about a number of the different applications of data. But when it actually comes to making decisions on ratings of individuals and putting them in risk classes, we have to have the appropriate authorizations, and then we have to use the right kind of data. So with the data listed here, I think everybody's familiar with MIB data. So this is data that is in the industry clearinghouse on underwriting actions. The point of why we utilize these different data sources, as David kind of mentioned, is as we think about giving up traditional medical information such as fluids and the information we can gain from fluids, how can we replace that, replace the protective value that comes from that information? MIB has been a great source of understanding other ratings at other carriers when adverse action is taken. David mentioned RX and prescription drug databases. Life underwriting has long used RX information in traditional underwriting. Now, though, we're seeing the development of automated RX scoring mechanisms that can help form the connections that human underwriters had to make, such as looking at the drug, the prescribing physician, and the dosage to map that to a likely medical condition. That was the realm of human underwriters before, to use their intuition, knowledge, and experience, and then maybe corroborating that with physician records. But now we're seeing that being done through rules-based mechanisms based on studying the long history of that information that we've always utilized. Motor vehicle records, again, another long traditional source, but now we're seeing, again, digital options there. Lab results is kind of an interesting one, and where you can get results from lab-based tests from a number of your applicants. The trick with that one, though, is sometimes you'll miss some of the largest elements that we look for in underwriting. For example, when you're going to your regular physician visits or your doctor's visits and you're having a lab test done, they may test your cholesterol, they may test for some other elements, but they probably aren't testing for cotinine, which is what we use to screen for smoking, or drugs of abuse. And so sometimes you'll miss some of the big hitting underwriting elements in those lab tests, but still they can provide some of the protective value that you may have seen out of your traditional blood results. I'm going to skip down and talk about a couple of the other ones near the bottom of the list here, because David already mentioned some of the credit-based insurance scores. Electronic health records is really an area of high focus in the underwriting space. Knowing that the attending physician statement has been the gold standard, if you will, of underwriting information, how can we replicate that in a truly digital fashion? Electronic health records is what people are looking towards. Certainly the challenge here, if you're not familiar with the space, is the connectivity and hit rates that we'll find. You as a consumer can go out and request your digital health record from any one of your doctors, and they should be providing those to you. As an insurance company, though, the ability to go out and get that at scale across a number of your applicants is where we're at in terms of what the challenge is. And really that's driven by market segmentation of those providers, of the software underneath, and connecting those up. In fact, most likely hit rates that people are seeing right now is maybe in the 20 to 25% range. Certainly that can scale up geographically and otherwise, but in mass, nationwide, you might only be in that range. So broad scale mass utilization is still maybe a couple years off, but certainly there's a lot of work going into this space. And then lastly, just to hit on the two at the bottom here, consumer data and social media data. These are ones that often get a lot of press. Number of articles, I think even one written by the Wall Street Journal over the last year and a half around underwriting and looking at social media information. first point is, there are not a lot of companies really actively utilizing this information. And again, I would point to the reason and how companies use information. I'll hit on this a bit later, but there's going to be a difference between utilizing information to make an underwriting decision, and a decision either based outright on risk classification or value of information, to a decision to look at the disclosures that someone provided. As we give up something like fluids, and we still rely on client disclosures, we're actually relying on those client disclosures more so than ever historically. And so we need a way to be able to verify and tell, to the best of our knowledge, whether or not those clients are being 100% or those applicants are being 100% forthright in those applications. And so sometimes these alternative data sources can help us make those assessments. For example, something that's traditional would be in the RX space, where we could ask applicants for a listing of their prescriptions and compare that against what we can find from a prescription data pool. That may inform us on whether or not we would want to, first of all, dig into those prescription histories more, but second of all, really reflex and dig into some of the other medical histories that they may have or have not disclosed during the application process. Likewise, that's where some of this alternative data could be utilized, is really trying to reflex questions or processes that individuals experience in now a digital fashion to gain the highest level of disclosures possible.
Jason, we've got a couple of good questions have come in. I'll start with one. It's around use of credit score and regulators being negative about the use of credit scores and thinking that that skepticism will persist. How do we address this as a life insurance industry, and how do we move forward working with regulators to use that data?
Yeah, it's a really great and timely question. So certainly when there's new data that is, as you kind of use the word, David, like orthogonal and predicting risk in a very different way than what we've traditionally done, I think it's natural to have skepticism about the validity of that data and the validity of those results. So a couple fronts here. Number one, I'd point to, this is the perfect opportunity to work with your domestic regulators to help them understand. I think a lot of times whether things are just hearsay or put out in general publications, it creates a certain type of appearance of what's going on, and so certainly there's opportunities to work with regulators to help them understand not only the data itself but how you're using it. So one, I'd ask us all to embrace that mindset of just educating everyone here, so we have a better understanding. Within there is certainly the data and studies, and you can look at the numbers all you want that show the correlative properties of credit data to mortality or outcomes. But I still think there's going to be a level of skepticism that exists beyond that. And one of the things that we've tried to really focus on is, historically, we've always underwritten, I think, in two main perspectives. One is the medical information that gives us information about the person's either current disease states or nearly developed. So whether you have diabetes currently and are managing that, or whether your BMI is elevated and are likely to develop diabetes in the future because of that, or have a higher risk for heart disease. But we've also always underwritten based off of behavioral data. And I'll use motor vehicle records as an example. If you have a history of major moving violations, you have a significantly improved higher propensity to die and die earlier. But those deaths that all cause mortality increase are not from car accidents alone. There is other deaths that contribute in there. And what it points to is that the risky behaviors that are identified through motor vehicle records really permeate across your likelihood to die from many different impairments. And that could result in not following doctor's recommendations, not taking drugs as prescribed. There are a number of ways that behaviors manifest themselves and create adverse mortality outcomes. MVR has just been a tool that we've used historically to try and identify those behaviors. Now we're seeing new tools come online that can help us identify those behaviors even more acutely that could lead to adverse mortality outcomes. And so I think there's a focus area there where we need to spend more time trying to educate and look at the behavioral contributors to mortality and morbidity rather than just kind of current medical conditions.
Yeah, and one thing I'll add quickly on that, Jason, is that the CDC accident numbers, Center for Disease Control, it's accidental death is the main cause of death up till about age 45, and so the credit scores and other personal behavior type of attributes are pointing to that non-medical, that accidental risk, and give us something there. But it's also not just the risk of the mortality risk; it's also the risk of someone, the anti-selection risk involved, because if you have a low credit score, you're more likely to lapse your policy unless you really need it. So it's not something that we can easily break out and look at the financial impact of that versus the mortality, but you're going to see higher actual expecteds with those lower credit or credit attribute scores because you're going to have that anti-selection involved there as well.
Yeah, so we could spend a whole webinar talking about credit-based insurance scores, I know. So one, I'd encourage, if you have a couple other acute questions here, why don't you go ahead and submit them. But from this, I think we're going to move forward and maybe come back to some of the other additional questions near the end. Not only from the data sources, you started to see the development of scoring mechanisms. David already mentioned one of them, scoring of credit-based insurance information. But as other vendors have had their own data available to them, they've been able to tie that information directly to mortality outcomes. So we've seen lab scoring algorithms created, prescription data scoring algorithms, credit, electronic health record scoring mechanisms created now, where they can actually use the EHR data to create a mortality-based score. We have scores based off of like criminal history and other public information. Different vendors are working on smoking propensity and avocation propensity scores. And lastly, there's scoring mechanisms around misrepresentation. As I kind of mentioned before, the reliance on client disclosures going forward is significantly higher, I believe, than what it has been. And so can we score applicants based on how truthful we think they're being throughout the underwriting process? So one of the things that this creates for us is, how do we incorporate all these different scores into models? Where are we going to model based off the underlying information? Where are we going to buy these scores from the vendors themselves and have to understand the models that went into them? How are we going to incorporate those scores into our own models and rules-based processes and have a model of models, if you will, as one potential solution? So much that can be fit to purpose here for each individual program, but certainly the development of this, and we have to be able to utilize these different sources. Within and what type of models we use, so if that's the data, what are the modeling and the modeling techniques? We started with models that we knew as actuaries, generalized linear models. If you go back to maybe dating myself, the old Course 7 seminar where we had to actually build a model, that was a generalized linear model approach. And so we started with what we knew and kind of followed in the P&C footsteps. Now with the advancements in techniques and bringing in data scientists and our own understanding, certainly the model sophistication has grown to things as random forest or neural nets. The software has also improved. So whether you're using Python, R, SAS Enterprise Miner, or something else, certainly the capabilities are much larger. I think that the key question here for us going forward is, how do we balance performance with explainability? The more complex models that we can use, we may be able to eke out better performance in whatever targeted approach we're trying to utilize, but sometimes that comes at the expense of explainability of the results. And so that's the key question for us as actuaries as we try and look at this. And that's explainability to ourselves, to our peers, to our business partners, to our leadership at our companies, and also eventually to regulators and the general public, as they may have questions on, well, how did I get rated in this way, or why did this result happen? We'll have to have the right level of explainability for that and to be able to talk about that. Lastly, we're going to hit on regulation here in this section a bit. As I just mentioned, that's going to be a key part of how these models move forward, and David kind of foreshadowed this before. There wasn't a lot of kind of initial reaction, certainly a lot of learning and awareness had to be developed. The New York Circular Letter was a big development earlier this year. And so that had specific requirements that it set forth around accelerated underwriting programs and the use of external data as they defined it. PBR has now had some assumptions and pieces to it that have come out around how you treat accelerated programs or mortality assumptions that would support that. And we're seeing on the PNC side, even while they've been longer at this, they're still working on like best practices for how regulators review their filings. So again, I mentioned I think what's most beneficial in here is the ability to work with your regulators to help them understand how we're doing accelerated underwriting, how we're using predictive models in our processes, and I think that partnership can go a long way for helping us be successful in the future. And now I think with David, I'm going to set it back to you.
All right, thanks, Jason. I'm going to touch on one more question before we continue into the staffing discussion, and it is how do you verify the accuracy of the alternative data sources? How are applicants able to contest or correct that information? And I can give you our company perspective, in if we think back to I'm going to go back a couple slides here to what Jason was presenting, and we are ensuring that the data we use for an underwriting model needs to fit in either one of two buckets. It's either FCRA compliant or HIPAA compliant, so that there are rules governing its use, its verification, and that someone is able to get that information that we use for our decision and contest it if they think it's wrong. And that again, building that experience, getting the authorization up front and being able to use that. So if you look at this, a lot of these are going to be FCRA compliant, and if you get into using EHRs, that should be covered by HIPAA. RX is covered by HIPAA. The ones that don't really fall into that are the ones at the bottom, the consumer marketing data or the social media data. And again, I think based on the answers to the survey, that reflects the questions about how we use it going forward. So I think making sure that your organization has clear policies about how you use data, how you ethically use data, how you let people contest that is something that's important to bring to the regulators as you have those discussions so that they're aware of it. So we wanted to touch on a couple other topics as we go through this in terms of staffing a predictive analytics department, and it's something where I think there's a lot of our organizations are challenged now to figure out where does this belong, who's going to run it, do we have the data scientists to build these models, and I think that's certainly a driver behind the SOA really pushing this capability as something that they want, not just new actuaries who are still writing exams, but also existing actuaries with some of the programs. One of the benefits that we had as we built models here is that we are multi-line with a large P&C company, and we had an existing team of data scientists that are working across the board on marketing models, claims models, auto pricing models, taking weather data and producing catastrophe models. So we had experience from the data science side where we could draw from. We could bring people into our projects. So then there becomes the challenge of making sure they have the domain expertise and making sure they understand life products, annuity products, etc. So you need to kind of team with sort of the core data scientists with someone who has that domain expertise and understands how the data fits into the business problems within the life industry. So with our teams, we had actuarial representation. We had some other analysts who had been within the life company and had a number of years experience. and we had underwriting expertise as well to really understand the process and the pain points of what we were trying to do. So we were able to build a broad team. Again, we're not looking for unicorns that can do everything. We're really trying to put the pieces together and have a number of role players that can work cohesively as a team. It is important to, I would say, as an actuary, to take, if this is of interest to you, take advantage of what is out there for education. That, you know, between the industry conferences, the SOA ones and other, there's a lot of good sessions. There's the SOA has the Predictive Analytics certificate program that even if you just look into that from a syllabus standpoint of what's being taught, or look at the PA exam and look at the material that is part of that exam and how to get a base level for using some of these advanced data tools. I have one person on my team that's currently doing a master's in data science, so that is something that is going to allow them to, you know, accelerate the roles they can play on some of these projects. And we're also starting to see a number of third-party training organizations that are willing to come and you know, are they going to teach your actuaries data science, or are they going to teach your data scientists life insurance? So that you know, you can look out there and find things of how to really, you know, grow a team and build a team and get the capabilities you need going forward. I wanted to touch on competition and kind of our perspective. When we started building an accelerated underwriting program 5 years ago, about 5 years ago, we were really worried about the other life insurance companies. I was worried about Jason and people like him building something that was going to get ahead of us and have a better customer, a better user experience for that underwriting process. But, you know, what has really happened over, I'd say, the past 3 years is that all of a sudden there's this proliferation of insurtech companies coming into this space and really attacking all areas of the value chain, and understanding that insurance companies traditionally are about risk management and haven't been as good about the customer facing or the customer experience or continued engagement, as we see with some companies that are using wearables and trying to incorporate wellness programs. People are attacking even the way products are built. And, you know, do you need a long-term product, or do you need something that adapts with you and you know, what stage of life you're at? So, you know, certainly, you know, the two of us being from large mutual companies can you know, our value proposition is we are a large, stable company. We're going to be here for another 100 years, and we're focused on providing member value. And it's a very safe place for insurance. But you know, what is really going to resonate with the customer, with the buyer of life insurance? And I think that is really about why this is evolving, because we have to change the way we do business and keep insurance as something that is relevant as a means of protection. You know, one thing I worry about is whenever you see you know, a tragedy, someone dying too early, the first thing you see is they've set up a GoFundMe account. I don't want that to be the case. I want them to say, well, they were protected because they had an insurance policy to protect against that risk. And that's always going to be a challenge, but, you know, by making this, you know, product easier, faster, I think it can get around, you know, that friction of actually buying the policy in the first place. It's not going to be easy. As an industry, we've been trying to do this for years. Jason, I don't know if you've got any thoughts on that you want to add?
No, I think you covered it pretty well at this point. David, why don't we go ahead and keep moving?
All right. So we want to, you know, cover quickly a bit on some of the successes and failures and what we've seen in our own projects, and then we'll you know, do a bit of a look ahead and see, you know, we've learned a lot over the past few years. What happens next? Where are we going next? So I'll say from the nationwide perspective, changing your process changes your data. And when we went to an accelerated underwriting process, we had built our models based on agent collected data, paramed collected data, and it was important to us that you want to have veracity of your application data, and one way to do that was to switch to a tele-app where you have people tend to be more honest on the phone rather than having their agent filling it in for them. What happened, though, was all of a sudden we were seeing people answering questions 3 times to 5 times as often as they would previously in our data, which on one hand was good because we realized our data was much more honest now, but it also completely invalidated any work we did on our prior model because it kind of proved that the application was not worth the paper it was on in the old way of doing things, and that you really needed to rely on labs and APSs because your application didn't get you any valuable data. So that's something we're able to pivot on and quickly rebuild our models and get much better acceleration rates to where we were expecting. Certainly as we go through this, the underwriting risk class itself is a biased target. That there's a fallacy of precision in underwriting where you do all this work and then you drop them in 4, 5, or 6 buckets. In fact, we're trying to get to where we can understand mortality better, but at the same time, there's exceptions, there's stretch criteria, there's business decisions, there's all these things that are kind of pushing people up or down in their underwriting today. And so that's something where, getting through that process and getting a clean target variable is really necessary to start you on this journey. Other things, unexpected value in our data. We worked with our P&C company and built a model specifically with using, a model that was already built using auto pricing data and showed that it was predictive of mortality because I think, Jason, you had mentioned before that it doesn't just predict car accidents, but it predicts car accident deaths, but also general behavior. And then finally, change management and monitoring and controls. It's hard to change a process that's been in place for many, many years, and that will be a lot of friction, and that you will have to closely monitor people's behavior, people's decisions, model output, quality control, etc. So change management is never ending when you're doing something that is transformational in nature. So I'll throw it over to Jason for the Northwestern Mutual learnings.
Yeah, so I think those are some really great ones, David. I think the only things I'd add to that is, as you head into an accelerated underwriting process, every model's got a target. It's got a variable it's trying to predict. And if we're trying to predict and improve mortality of the segments and improve the throughput rates that people can have through a less painful process, we need to be real clear about what our mortality outcomes are that we're shooting for, what we're willing to accept, how we're willing to see mortality play out through the accelerated program compared to potential expense savings that could come from eliminating some of those higher hassle requirements. So just getting really clear organizationally on what you want those goals to be makes the process from that point forward that much smoother. You kind of touched on resetting information a bit, David, and how that changes your process itself. I also think about understanding your data and where it came from. If historically you've used, or you're going to build a model off of historical data, and that data has historically changed through the underwriting process. Let's say that someone went to a paramed visit historically and had a certain blood pressure, and then you ordered the medical records and they had differing values of the blood pressure. Did you only record one value? And if so, where did it come from? Did that data get reset at any point for the process? And if you want that to look like what it did at the point of application, how do you go back and recreate the data from where it came from? A big piece is trying to understand what a model miss is versus misrepresentation. And this is really key for us as we talked about it with our underwriters. A classification-based model will miss. No model's perfect. And so it may give someone a preferred rating who would have otherwise been standard. That goes back to the first point in understanding your mortality impact. But if everything on the application to that point was 100% accurate and truthful, that's the result of a model miss. Misrepresentation, where someone wasn't truthful on the application, and the model scored them based on the information it had, and gave them that preferred rating. That's a different result. And so, just being real clear on, we still have to deal with misrepresentation. Still have to have our rescission and reformation processes that we've had before. They may feel a little different, but not that the model's making those mistakes. Lastly, goes together a bit is some of the kind of creative blending of human and automated processes. This is not a thing that's one or the other, and I think there's real leverage to be had for getting creative about how you use people and technology together to further your throughput from an accelerated program. And very lastly, how you position that with your field and your distribution partners, whether that's brokers, career distribution, or other. How do you set the right expectations for the process, for throughput, and what that will mean? Because I think that'll be real key in terms of getting overall success out of your program.
Great. Jason, have you done anything, specific examples of what you've done to recreate old data or reset data as you're trying to build a more robust model or get more data points to model on?
Yeah, and so, one example, and this was and again, it's going to depend on your own systems and how you design it, but for us, an example was, which variable for smoking did we grab? Was it the, applied for tobacco, so based off of the medical history questionnaire disclosures, or was it based off of the tobacco indicator at the end of the underwriting process, after you've had blood results or after you found an APS? And using that within your data set, because certainly you'd want to reset it to whatever the data looked like at time of application, which would have been based off of their disclosures only, not the result of including all that other information. And so that was a very early on, thing that we just had to discuss with our data scientists was, what was the data that we wanted to use, and was that reflective of the information at time of application?
Okay, good. I was going to give one example of that as well, where we've used OCR to digitize old labs so that we have a much deeper data set where we have that data and can go back and start to get duration to actually look at mortality impact of some of them. So there's times when as insurance companies and being a little late to the game in terms of the way we record and store data, that there are ways that you can actually grow that data set of usable content out using some of the advanced tools we have today. All right, so we've got about 10 or just under 10 minutes left. We were going to look ahead at what some of the things that Jason and I think are going to hit in the near future, and then we'll touch on, we'll try to hit some of the questions people have been sending us. So, where I'm, my thoughts going forward is that things are really going to move the needle based on digital health data and in electronic health records. So that's one area where we're looking at the people to potential partner with, looking at studying the data and see how that can give us a better view of mortality, how we can get more data today without necessarily having to ask the applicant for that data. Underwriting is a very adversarial process today where people who realize what's going on know that anything they answer, any additional check on their application is probably going to be bad for them in the long run and perhaps increase their rate. So, can we automate some of that? Can we pull in data that from their EHR and really ask them to verify as opposed to asking them, everything that's wrong with them? And can we make this more automated process? So one thing that I think it's important to be aware of is just the work that's going on in the healthcare industry around codification and standardizing of medical data and medical codes. Some people may be aware of ICD codes and the codes, NDC codes associated with the prescription drugs. But there's also something called SNOMED, which again is a standardization of medical terminology. And as we grow our database, as the health industry grows, the ability to understand and move this data around between health companies, insurance companies, and others to be able to get a better picture on what someone's status is, history, progression, and ultimately what that means to their mortality risk is very important. I'm going to touch on one question we received earlier, which is, what do you think about Google's Project Nightingale and how it will change the landscape? I think there's so much going on right now, especially from Google, Apple, Amazon around health and health data, that we're watching it closely, and I think that there's going to be some major transformations going forward in the data that's available. I think this is probably an area where regulators will need to pay attention, understanding who owns that data, how it's used. My view from an insurance perspective is that this medical data should be the domain of the person who it should belong to the patient. And as an insurance company, I'm hoping that that's something where we can be in that infrastructure to share that patient data with us, so that really we can make this a seamless process. But from a disruption factor, it's something to pay attention to, because there's a lot of work and a lot of very very advanced companies looking into how to monetize this health data that is out there and being propagated in the industry. So that's kind of my view on next steps. Jason, I'll pass it on to you. A couple thoughts around some of the products.
Yeah, so certainly life insurance has been the space of innovation in accelerated underwriting to date. I think the next horizon will be in disability income. DI to date hasn't had much in the way of focus on accelerated underwriting, but I think a lot of the learnings that we've developed on life can be applied in the DI space, especially when it comes to the medical underwriting of component. DI is a bit more complicated when it comes to underwriting, because there is a higher focus on financial information, and there's more levers to be pulled in the DI product itself to manage risk. And that makes targeting specific underwriting outcomes a little harder because it's a little less clean to point to just a rating. There are ratings and riders and different levers that can be pulled. But I think DI is the next natural place where we'll start to see innovations in accelerated underwriting. And the last piece is around, I mentioned this before, the kind of idea of behavioral and truthfulness or veracity. As we create digital interactions with our clients through the application process, we'll be using more behavioral economics design or behavioral design, more A/B testing of trying to get those questions dialed exactly right. We'll be looking at the misrepresentation that we see on those digital interaction forms, and we'll be able to dive in there really keenly and with separate predictive models, as I said, to actually predict truthfulness of individuals, either outright by comparing disclosed answers versus third-party data, or based on other patterns of their behaviors as they interact with the form. All of that will lead to us to a place where, in my words, like we get to use creepy versus cool. How do we work with the individuals and the applicants? What do they like? What do they not like? What do they find intrusive? What do they not? How can we make that process easier and maybe even delightful for them as much as we can, while also maintaining the protective value that we need from risk assessment? So those are some of the next steps I see coming on the horizon. Ultimately, I think we're all trying to push for kind of real-time underwriting decisions at some point in the future if we're not there yet. Interested in people's thoughts on that. But maybe one question that I saw that I'll address here right away is how do you really track results from these programs? Given that they're mortality-based outcomes, how far do you track out in the future? Well, I think one thing, first of all, is you can track disclosures. You can track the nearer-term items first. You can track underwriting classifications. You can use your holdout sample. You can use your post-issue monitoring that you have of your programs, to get a real good feel from at least a risk classification standpoint. Is your program performing as expected? That can give you an idea of whether your expected mortality is in line with what you originally laid out. Certainly, you'll track actual mortality results as they develop, but those initial things should give you a real good feel for how your program is performing initially.
Let's see. We're a good number of responses to the poll there, and we're seeing a little under 2/3 thinking that we can get to a fully underwritten decision. We probably should have put a time frame on that, Jason, as well, to see if that's something that could be done now in 5 years and 10 years. But it's something that we're working towards, and as an industry to understand that better. So it looks like we have covered the content as promised in 60 minutes, Jason. Good job with our timing. And I think we have a few more questions on here that we can cover. And please, we've been getting some great questions. Keep typing them in, and we'll try to get to everyone's. I'll go to one now. It's we see multiple models being used in selecting lives for one case of underwriting. For example, if you're using a credit attribute model and an RX model simultaneously, does this result in overcomplicating the risk selection process as both correlate with all-cause mortality? I think that is a great question, and it's something that we and others are probably trying to figure out the best way to use all the different tools that are coming out. There are certainly providers that are saying we can incorporate everything in the industry into one model, so you only have one place you need to go to, one check to write when you want to use that data to help your underwriters. And so from a transactional or operational process, that may be an advantage. For us, because we have our own internal models that we combine with some third-party data models. To us, making it more modular has been, our vision. That we know that there's a couple companies that are doing credit attribute. There's a couple companies that are doing RX. There could be value in swapping one versus the other. There could be value in using both because they don't use the exact same data points to produce those scores. And especially in, for example, like a credit attribute model where the models are really good at identifying, the low-end scores, which are considerably higher mortality risk. To have a second view on that can actually provide you protected value for the underwriting in the product you're looking at. It is certainly a challenge to understand that there's correlation or potentially dependent correlation that you're probably not going to get the benefit from a bunch of high scores, but there may be less correlation at the lower end of the scores. So that's something that we're continually trying to figure out what is the best way to really put those together and understand mortality. Again, it's something that we're still relatively new, from a mortality measurement perspective, that we need more data to really be sure on that. But a few ways to do it, not really a right or wrong answer, as long as you understand that yes, there is some correlation between a lot of those models and what they're telling you.
Yeah, I think the only thing I'd add to that, David, is really I think if you start from a place of understanding where your kind of competitive positioning is or competitive strengths are, let's say, around your current underwriting process, where do you get your most protective value from across all of your current requirements? With that level of understanding, you can look at these different products that are out there and decide where you want to buy, where do you want to build, how do you want to combine elements. As an example, take RX and RX scoring. So a number of vendors who have products out there, to actually build something in-house that is comparable to that, you'd have to have pharmacists on staff to keep up with the changing drugs and drug names and everything. And that's a pretty significant commitment of resources. And is that what you really want to do, or are you fine buying that information from a vendor? How would you feel about that if it was the detailed medical information coming from the electronic health record? If that's where you've had a particular expertise in your organization, again, would you want to buy those scores, or would you want to build your own perspectives on that information? And then how would you combine it with others? So I think you start from a position of understanding your strengths, and then look at that information, decide how you want to incorporate it. So there was a question that somebody asked around genetic data. I'll pop on this one. At least I'm not aware of anybody using actual genetic data itself. I think one thing you see on the marketplace today, if you're not familiar with the term, is something called epigenetic information. So I am by no means a geneticist. I rely on our doctors here for that. But basically the difference is, instead of your underlying genetic code, this is how your genetic code and your genes express themselves. And so that can be influenced by your personal behaviors and your health. So for example, if you smoke, it has been shown that you've actually done some permanent damage to the way that your genes express themselves. If you drink excessively, you may have the same thing. So there are companies out there now who are offering epigenetic tests that you can do through fluids that could test for smoking and excessive alcohol usage. Maybe this is the potentially closest thing we could ever get to a term used as pack years, the amount that you've actually smoked over the course of your life, because certainly there is a correlation between higher use of tobacco than lower, whether it's just a binary yes or no, have you ever. We've tried to historically measure that through the disclosures, somewhat, maybe through the cotinine levels in your blood. But if something could be a little bit more accurate in that regard, that could be encoded within damage that you've already done to the way that your genes express themselves, that could be an interesting place to find out that information. So I've seen some carriers start thinking about and looking at these vendors that offer epigenetic tests rather than your genome itself.
Yeah, I believe, Jason, that in Canada that genetic information is not allowed to be used in underwriting. So
correct.
It's something that's been flat out no. I think it's seen as a slippery slope, and so people are not going down that road. But at the same time, I think you have maybe a few genetic things where, like Huntington's disease, where there's a 100% chance that if you have the gene, you will get it. But a lot of genetic testing is only going to say, it may say, well, you're 2 or 3 times as likely to get a certain disease. But what if that, increases the chance of you getting it, from 0.001% to 0.003%? It's still, the likelihood that that's going to impact, your all-cause mortality. It's very slim. So. That I think people hear genetics and think we can have this view of exactly when someone's going to die, but really it's just another factor into looking at a distribution of when someone is likely to die, and it doesn't give us a lot more signal, if any, in most cases than we had before. So one interesting application, though, of genetics that I have seen talked about at a couple conferences is using that instead of adversarially for underwriting, but use that to, in fact, enhance the experience. And where if you have someone that, for example, has a life insurance policy with you and develops cancer, that at that point you can run a genetic screen and have the insurance company pay for it. And with the technology and the advances in medicine today, that they can have a much better idea of what drugs can treat certain diseases using a genetic screen, and actually have a much higher chance of putting cancer in remission, for example. So I think, as an industry, that may be a better place to put our research into making a partnership with the insured rather than continued adversarial things, kind of gotchas within the underwriting process.
Yeah, exactly. That area of pharmacogenetics is really big. And maybe just to build off this conversation, David, I'll ask you this question that kind of came through because you were kind of mentioning it there around kind of the genetics and predicting mortality. Do we think that predictive analytics and the advances here will ever allow us to get to completely individualized life insurance underwriting models, or kind of the term of a risk class of one? Is that feasible logistically, and or how would regulators feel about that? What are your perspectives?
Yeah, I think from a statistical standpoint and a pricing standpoint, it's certainly achievable. I'll actually say that I don't think the barrier right now is the regulation. I think the barrier is the distribution, and that the expectation of brokers and agents is that you're going to evaluate my client and tell me, are they preferred, are they standard, and then maybe I'll go back and push on that factor. I think if the distribution changes to where it's more of a consumer-driven market for insurance, and people are comparing more on price, then risk class doesn't necessarily matter, and the insurance company may have more flexibility to do that. From a regulatory standpoint, yeah, how do you reserve for that? Do you still need to bucket people in terms of assumptions and experience studies? Perhaps, but my view is that it's going to be harder to overcome what the distribution tells their clients that they want at this point.
Yeah, I think if you hearken back to the start of a presentation and you talked about the evolution and following in the footsteps of kind of our P&C brethren, certainly you've seen this change there, right? Where when you're getting quotes for your automobile or homeowners insurance, you're not getting quotes and saying you're in our preferred best class. You're getting quotes based on your risk profile. And so will life insurance or other disability or long-term care go a similar way, where the notions of kind of consumer and disclosed risk classes start going away and it looks more like P&C insurance? I think that's certainly a possibility. You hear the phrase micro-segmentation utilized as well, moving away from the size of risk classes that we have today and being able to cut those smaller and smaller. Do we ever get to the class of one? I'm not sure, and I'm not sure if that makes sense, but certainly I can see a future where we get smaller than what we have been historically with more and better data.
Another question, what do you recommend in terms of best practices and model controls?
So I think, one, I mentioned this before about holdout samples and post-issue audits are two pretty industry standard practices. I think even beyond that, though, and when I think about what we do, we have some automatic checks that we're doing as our accelerated underwriting is running data quality. And so we look at kind of key data elements to our model really on an automated and daily basis. How is that data flowing in? Do we see any data issues in the data itself? And I'll give you an example where we actually had a situation where, because of some other corporate projects going on, that somehow our access to one of our data sources was shut off for like a day or two. So immediately we saw a whole bunch of null values come through one of our key data sources, which was highly unusual and completely unexpected. And so we had to kind of immediately react and say, well, are we going to shut off the model in terms of what it's processing? What did that do for cases in that day? Did it approve or not approve? And we were able to take appropriate action. We weren't at a place where we had automatic point of sale decisions, and so we were able to adjust some things. But I think data quality monitoring, first of all, is a key component. Throughput monitoring for extreme outliers is important, and then your holdout sample post-issue audits, I think, are best practices for measuring how your model is performing.
Yeah, I agree with all of that. I think especially at key points when you're implementing a new model or making a model update, looking very closely at the data that's coming in. And we have caught occasionally an error very quickly after we implemented something where it was just an error in code, and we've in fact had where a provider all of a sudden the name of a variable changed and was causing a bunch of cases to bomb out. So these things happen. So having the right controls is very important as you implement something. Let's see, probably have time for maybe one more question. How do you test the reasonableness of input data?
So I think one, it's understanding again like where the data came from, what does it look like historically. So if it's data that you're familiar with, right, you'll have an ability to test that against your historical data sets that you're building your model off of, and seeing if kind of go forward production data matches what you've seen historically. Having a business perspective on that is really, really key. So as you talked about the makeup of your team, right, do you have the right business and underwriting perspectives in there with your data scientists to understand what reasonable looks like? If you're talking about a new data source that you're not as familiar with, I think you have to do your diligence with those vendors and providers to understand key dependencies, sensitivity tests. Really, I would almost point you to the modeling ASOP that's under development in terms of our responsibility as actuaries to understand the data that goes in it.
Well, great. That brings us to our 75 minutes. Thanks so much, Jason. It seems like the time just flew by again, as it did in September. With that, I'm going to pass it on back to Eric to wrap things up for us.
Thank you very much. With that, we will conclude today's webcast. If you do take a look at the links box on the left-hand side of your screen, you will see a link to the webcast evaluation. Please take a moment now to complete the evaluation and give us your feedback on the program. Click on Submit when you have completed the evaluation to submit your responses. Your comments and suggestions are very important to us, and they help us to provide you with this kind of quality programming. To register for any of our upcoming webcasts or meetings, or to purchase recordings of previous webcasts, please visit www.soa.org today. Thank you for your participation in today's webcast. We hope to see you here again soon. Today's program is copyright 2019 by the Society of Actuaries with all rights reserved. This concludes today's program. Thank you. You may now disconnect.